Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Jan Szilagyi. Jan is the CEO and co-founder of Reflexivity. Founded in 2019, Reflexivity is an investment intelligence platform that offers advanced AI and institutional-grade data tools, primarily for the institutional market. Prior to founding the firm, Jan worked at several prominent investment firms, including as co-CIO of Global Macro at Lombard Odier, as well as a managing director at Fortress Investment Group and Duquesne Capital Management. Jan, welcome to the podcast.
Hello, thank you for having me.
Jan, looking back, you have such in-depth experiences in the investment world. How has that shaped your philosophy, and what, if any, impact has that had on the design of reflexivity?
It was really the experience that led to creating Reflexivity. In fact, a number of us at Reflexivity came from a similar background to mine, which is from the buy side, managing either global macro or long short equity funds. And what we felt like was sorely missing in the age where data became abundant was the infrastructure that could fully take advantage of it and extract all of the insights from it. And so Reflexivity was born.
And sort of at a high level, artificial intelligence, the major theme in the markets today. What are the themes, though, in your own mind for artificial intelligence in the investment world? What are you focused on?
I think what is currently the most exciting prospect from where I sit is that the technology we're seeing and the excitement around AI, specifically in finance, I think is increasingly focusing on the ability of portfolio managers and analysts to take use of its capability to connect the dots more efficiently. Unlike a human analyst that will generally think and calculate relatively linearly, you start with an event and then you're thinking about the implication of the next implication. The ability of a system like reflexivity to take an event and then simultaneously process the implications for virtually the entire asset universe is really unparalleled. And it's exciting, particularly in financial markets, because if anything, and this has sometimes been a source of a lot of frustration for people who participate in it, there's so much going on at any one time. There are so many different linkages we're trying to appreciate that it can be mind-boggling to a human mind, but leaves reflexivity and AI technology at large completely unfazed.
And is there anything that you would think that's sort of still underappreciated by the investment world or misperceived when people in the investment world think about, I'm going to use AI as part of my platform?
I mean, any number of things, in part also because the development of the technology has been so fast that some of the use cases that we are contemplating now didn't even seem possible when we first started playing around with the version one of ChatGPT, right? So you are seeing, and we're talking to a number of our clients who tend to be hedge funds, large and small, about the idea of creating AI portfolio managers, of creating autonomous analysts, and so on. And these are now becoming maybe not yet reality, but certainly a possibility. And you are seeing this interesting range where there are some investors who are still trying to figure out if AI will even fit in their process, and others who, like I just mentioned, are contemplating entire strategies that would be autonomously run by AI.
And are autonomous strategies, are there risks to those, do you think?
There are, but as we have seen, human errors are a risk too, right? It's not as though we haven't had mistakes with traders pressing the wrong button or adding a couple of zeros and so on. So there are risks. I do think, however, that unlike with humans, that I think we are more comfortable giving a lot of responsibility. With AI, what we have seen, the experimentation and the trial and error has been very measured. In other words, I think people are definitely treating this as novel technology that's not yet fully understood by everybody. And so any implementation tends to come with a lot of disclaimers, guardrails, and so on.
And can you, Reflexivity has a proprietary financial knowledge graph. Can you sort of elaborate on what that is and why is that so valuable?
Yeah, so it's a great question. The point that I was making just earlier, which is that one of the benefits of this technology is that it can do ultimately this kind of multi-dimensional synthesis of really looking at many assets at the same time and so on, can also lead to issues if you don't give it some kind of a map of how these assets and how these relationships work. In other words, you want to give the system a degree of understanding that a steeper yield curve could be good for banking stocks, that a rise in oil prices could change the attractiveness of the ethanol gasoline blend and so on. If you give it that kind of mapping, then a lot of people are much more, it basically creates not only answers that are more accurate and faster, but it also allows you in some way to get much more consistent answers day in and day out. And the comparison that I would give you is if you think back to the days of the early search engines like AltaVista, Yahoo, Lycos, Google, and so on. What made Google exceptional early on is they realized that by reorganizing web content based on the density of the links between pages, resulted in faster and more relevant answers. And practically overnight, all of us switched. The knowledge graph acts as a similar type of ontology here that ultimately allows somebody to use the full power of a large language model, but the accuracy that a financial professional demands of a product that is to be used in high stakes investment decisions.
So let's take a hypothetical. Say I'm a value investor looking to construct a portfolio. My concerns are, say, geopolitical tensions. We've got a new Fed chairman coming in, and the S&P 500 is still somewhat concentrated in technology. But I'm looking for value, and I want some ideas on how to construct a portfolio that fits that criteria. How could that one person use reflexivity to do that?
So this is a good example. So let's say going with your construct here, um, if you give a system like reflexivity a certain set of criteria, so in this case, you're saying undervaluation, maybe you need to specify a little bit more like undervalued relative to what and relative to what horizon and so on. It's then able to, in very granular detail, highlight securities that are undervalued relative to a set of scenarios that could take place over the next 6 to 12 months. In other words, a stock can look wildly overvalued if you think that actually their earnings growth is about to plummet, or it could look an incredibly attractive purchase if you think that the earnings momentum is actually about to pick up and skyrocket. Now, how does a system like reflexivity pick up on these scenarios? The knowledge graph basically is able to trace out relationships between the macro and the micro. And so, how does the anticipated macro environment impact the earnings of particular companies? It's also able to appreciate the relationships between companies. And so, let's say you had an earnings report by Amazon, and people mostly focus on consumption, but there is also commentary that pertains to their logistics unit, right? Amazon ultimately is, as we all know, an incredibly efficient deliverer of packages that we order on there. That could be used as a read-through, for example, on FedEx, UPS, and other companies that are involved in this. I'm giving you a relatively trivial example, but the point that I'm trying to make is that if you constantly keep track of all of these connections, you as an investor are able to tap into that when you're then saying, okay, assuming scenario A and scenario B, taking into account all of these relationships, in 6 months' time, which of these companies could look a really good buy given the dynamics you're anticipating?
And you touched on it before, Jan, a little bit about your customer base, hedge funds you mentioned. Um, is that primarily the customer base, or is there also sort of traditional long onlys in there? And is it hedge funds tend to be early? Is that why they're the early adopters for this kind of service, do you think?
Yes, as you highlighted, they tend to be early. It's a very competitive industry, obviously, and so anywhere where they can find an edge, they will be more willing to experiment. So yes, that is kind of the core audience, we have seen and have started onboarding also clients in the long only space. We have a number of sovereign wealth funds, pension funds, and so on. And most recently, have also started seeing quite a lot of interest from some of the larger investment banks.
Right. And is it primarily the use right now, analytical and portfolio construction, or are there other uses here that people are generating from?
There are two key capabilities. One is idea generation. So when people think of AI, they often think, oh, ChatGPT, Claude, like somewhere where I go and I have a conversation with the machine. In fact, for us, a very important aspect is the system's ability to continually monitor news developments, geopolitical events, changes in the data, changes in trading volume, and so on, and highlight to the portfolio manager events that could have ripple effects on securities they care about. As an example, you might see the news come across the tape that says, oh, you know what? The Strait of Hormuz is about to be closed again. The system will highlight not only the news itself, but also which companies in your portfolio are likely, as a result of that, to be impacted, why, and by how much, right? So it's going to trace out these same relationships to highlight. So the capability to proactively alert the user using that same technology about things that could represent vulnerabilities to the portfolio or potentially new trade opportunities.
It sounds like there's a very wide sort of channel flow of information through this service, basically.
And then very highly tailored. In other words, it does have an enormous catchment area. But the point then is, and this is obviously part of the value, is that you narrow it down based on what you know about the user. Meaning, I don't want to inundate the user with news that have to do with emerging markets if this is a long short tech only portfolio manager.
And as far as the type of feedback that you might be getting from your clients, is that incorporated all into the model over time?
So obviously the system gets a better understanding of how you operate, what do you like, what are the things that you're following, and can therefore get better at alerting you to things it will guess that you are able to do or care about. Not too dissimilar in some sense, and actually there are some parallels in, if you think of some of the more popular music services, the more music you listen to, the better it gets at then recommending things that might also fit that profile.
And you come out of the investment world where having an edge, I think probably it matters, right, to deliver investment returns. I'm wondering, when you look at the investment world today, is this the main sustainable competitive advantage that you see, the ability to use these tools effectively, or are there other ones that will sort of come out of this over time?
I would say that at the moment, you can think of it as competitive advantage. I think very soon it's going to become table stakes. In other words, you will have to be using these or else you will just not be competitive. I think we're currently still in the era where if you are using them and using them well, I do think they give you substantial edge. But as has happened time and time again with new technology in the market, think back to when people first started using a Bloomberg terminal. Probably the first 10 users really benefited because they had a lot more tools at their disposal. Today, we're kind of at an era where if you don't have one, you're really handicapping yourself.
And as these tools become more pervasive, is there any concern that possibly the consensus viewpoint becomes wider because everyone's using the same tools?
It's an interesting question, and it's one that I think is a little bit more nuanced than the answer that I'm about to give you, but I would say broadly not, because where we currently are, the system isn't saying, hey, this is what I'm thinking about the Fed, so I think you should go long the 10-year. It's more there to kind of highlight developments that are happening and what the implications could be, leaving all decision-making power to you. Similarly, the capability to do natural language analysis on really any question that you have, the results are very much going to depend on the quality of your question. And to the extent that no two people really always ask the same question or have the same risk appetite or the same horizon, I don't think you're necessarily going to get an amplification of consensus, but what I do think you're going to get is, the name reflexivity was basically derived from this idea that George Soros effectively had really spearheaded, which was that you have a positive feedback loop between fundamentals and markets, right? The fundamentals also respond to the market, not just market pricing fundamentals. I think that feedback loop is going to get accelerated because with the ability to connect the dots faster than you were before, markets will ultimately ended up getting to a conclusion that it would have taken days before in hours or minutes. And so some of these gaps, some of these mispricings, some of these opportunities will probably stay around for a much shorter period of time, which, going back to your original point, again means that at the moment, I think, yes, you gain an edge by having them. Eventually, without it, you will simply be unable to play the game.
And how do you see, the core roles in the investment world, research, portfolio management, trading, risk management? How do you see those roles changing 2 to 3 years out, 3 to 5 years out as a result of these type of tools?
I really hesitate to make any prediction 3 or 5 years out because of just the compressed timeline with which we're seeing development. But I would say that on a shorter horizon, let's say 1 to 2 years, I would definitely imagine that what you're going to see is tremendous ability for all of these roles to evaluate either opportunities or risks a lot more rigorously. Why am I saying this? At the moment, if you're pursuing a trade idea, you often spend quite a lot of time, and this was the frustration we had and what led to the founding of Reflexivity. You are often sourcing things from different data sources, combining them in some kind of analytical platform, be it, Jupyter Notebook or Excel, and then running the analysis. And you're doing all of that work with the knowledge that at the other end of that, you may not end up with a trade idea. It could lead to basically you saying, you know what, there's nothing here. So all the work was front loaded. Because of that, a lot of people had to rely on their experience and intuition to triage which ones to pursue and which ones you don't. At Reflexivity, the way we're looking at this is we are now massively decreasing the economics of inquiry. Put differently, the cost of curiosity for investors is declining very rapidly. And so you will be able to use your data lens much more frequently than you would have before, which means that when you're making a decision, you will make it because you've actually done the complete quantitative analysis, not just because your gut tells you that this is a risk and the other one isn't.
What about on the infrastructure side? Obviously, that's separate from your service, but it's in the news a lot. Data center builds out, things like that. In your own mind, is the infrastructure keeping pace with the demand for the service?
I think there's a sort of like a constant push and pull. In other words, I think we kind of are consistently, seemingly skating right on the edge of that capacity. And, you know, if it really depends over the next 12 to 18 months how degree of adoption changes or accelerates relative to how quickly we can build out extra capacity. Like if for whatever reason in the next 3 months, suddenly everybody decides, okay, now I really need to use AI, it could be that you're going to start to see some rationing there. Because again, depending on the complexity of the problem, you are going to be using a lot more tokens and so on. So I would say it's a fine balance at the moment.
And how much training does a client need on the front end to get comfortable with the tools and know how to use them effectively?
Virtually none. It's pretty self-evident. And what really helps is that I think a lot of our clients in their private lives are also consumers of AI. In other words, we've kind of come to be a lot more comfortable with the type of investigation that you're doing for investing reasons, because you may have literally just done the research for a trip you're about to take to Budapest and you did it with Claude.
Right. And we've touched on, the sort of how it impacts people's roles, the firms you're working with. And again, you came out of that world. If you were going to build an asset management firm today, how would you build this into the platform? How would you go about it?
I think first and foremost, I think you would really rebalance a little bit the kind of what I would say decision-making role and the research roles. Like I think today, one analyst can probably do the job of two or three, if not more, right? So if before I needed to have 10 analysts to cover 10 sectors, I can probably now have one analyst cover four or five of these sectors. At the same time, what I do want and what there is a premium for is original thinking. It used to be that there was almost a degree of self-censorship with financial markets. If you didn't feel like you had very strong quantitative background, maybe you shied away from this because it felt like you needed to understand option pricing, you needed to understand how correlation matrices work and so on. But if you now have reflexivity to do all of the analysis for you, and you just get to ask a lot of interesting questions, the value now shifts to that skill as opposed to you being able to do the calculation because you don't have to anymore.
And I would assume larger firms also are trying to develop their own proprietary capabilities. Are those sort of, can those coexist at the same time? Do you see that some firms, they're developing their own tools, but they may also be using a tool like Reflexivity at the same time?
So we have seen an interesting situation develop, I'd say, over the last 12 months. I think initially when this technology first came out, a lot of particularly larger funds decided this was a technology they needed to master and that they would build things internally. 4 years on, 5 years on, I think they've kind of come to the conclusion that some of the internal tools, and I'm obviously generalizing, it's not true of everybody, but it's true of many of them, are relatively underwhelming because running a tech firm inside a hedge fund is trickier than you would think. And so what has now happened is that we're seeing quite a lot of them using our technology to seed their internal infrastructure and then augment it with their own internal data, with some of the tools that they have developed, and therefore making it their own.
And do you think there'll be a phase though at some point where there's consolidation of some of these AI firms? That's sort of been the history a little bit of financial services as far as data, that a lot of these things consolidate over time. Is that a possibility here, or do you think it'll remain, I won't say fragmented, but there'll be many players in the space for quite a while?
I think on the data provision side, presumably there will be many players just because I think people have different rights and they have different content and so on. On the I would say, kind of processing side, meaning taking the data and then turning it into something that you actually use as a final product, yeah, you probably are going to get a certain degree of consolidation because to the extent that it's just really a tool, there will be enough similarities where I don't think you need, you know, 20 different firms basically doing it, just as we don't really have 20 different providers of the terminal that people use for data, for their data and so on. So in short, yes, but actually at the moment we haven't even seen the space be particularly crowded. It's kind of a mix of legacy providers and us that have been developing technology in this space.
When you think about the tools out of say reflexivity, um, and you raised the point before, a portfolio manager, when the portfolio manager basically becomes an AI very much driven process, where are we? Or do you see firms experimenting with that very much, and sort of what's been the results of that as far as how they fared?
I would say that the results where they try to hand it off entirely to AI have not worked particularly well. Like I think that has been pretty clear that just, using a general chat platform and telling it to pick stocks for you does not work. I mean, it would be obviously incredibly easy if you could drive alpha just like that. However, what I think has worked and where we currently are is that, we started with investors delegating some very simple, relatively low stakes tasks to LLMs. And that was partly because there was the issue of hallucination, there was the issue of accuracy. also issue of transparency, all of which reflexivity really confronts head on. As you basically give this kind of knowledge graph augmented technology to an investment manager, they start to delegate more and more complex tasks to this system. So I'll just give you an example. Over a period of about 3 months recently, we have seen the kind of the length of the prompts and the questions, which proxies a little bit for the complexity of the task, dramatically increased. Like it used to be that maybe, 7 or 8% of all the prompts were things that were not just one-liners. And now that number is closer to 20, probably in excess of that. And I think you're going to continue to see an increase in the scope of tasks that investors will rely on reflexivity for.
And lastly, what is your vision? What do you see as the investment firm of the future? Even though I know we discussed not going too far out, what could it look like once this tool continues to evolve and become more widely deployed?
I I think you're going to find some balance of, let's say, humans who are using AI in order to make investment decisions, right? Kind of discretionary management. And you're going to see some entirely AI-driven portfolios as well. A little bit like how, systematic funds can do very, very well, but they're not the entirety of the investment universe. There's definitely still a space for discretionary investors. And so I think with AI as well, at least on this kind of a shorter horizon, you basically, I think, see a mix of people who are just really good at using and combining human ability to kind of anticipate things and think creatively with AI's ability to then connect the dots, do the calculation, and jointly come to a conclusion, with things that are entirely AI driven and maybe rely much more on the strength and the speed of its calculation to take advantage of things rather than to be able to imagine the unimaginable and therefore profit from positions that people thought, oh, wow, I didn't see that coming.
Jan, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon.